July was a pretty hectic month here in the UK and abroad. We had a landslide election to kick things off, surprise voting results in France, and heartbreak at the Euros, only some of which happened to be on my bingo card for the month. But all of it is shaking up the markets in one way or another, and I'm going to help you make sense of things. Hi, I'm George, Finder's investing expert. This month we've partnered with Interactive Investor to bring you all the latest market news and insights from the past month. If you're interested in more content like this, do me a favour and make sure to like below and subscribe to our channel. After the country headed to the polls on July the 4th, the UK voted en masse for the Labour Party, which means a new government and a new Prime Minister, Keir Starmer. In the days leading up to the election, we did see the FTSE 100 index, which measures the 100 biggest UK companies, start to rise slightly. I suppose you could call it a Starmer spike, but since the election result, the index has been fairly up and down. Overall, there was a subtle sense of positivity around UK shares and the stock market in general. Markets hate uncertainty, so the fact that everything went pretty much as expected with the election meant no shock drops or wobbles, but there also wasn't much of a boost either, because the result of a Labour government taking over was basically priced into everyone's expectations already. However, the FTSE 250, on the other hand, which measures the largest 250 companies in the UK, has been on a bit of a tear since the election. Well, it's no S&P 500, which is up by around 16% year to date, but it has been performing well by sluggish UK standards. In election news elsewhere, we saw a tense battle between the left and the right in France, with the left ultimately winning, but leading to a level of uncertainty for businesses and investors. And in the US, what was already going to be a fiery showdown in November now has even higher stakes. But what does this all mean for UK markets? Well, all of the question marks and turmoil elsewhere plays into the hands of this new Labour-led UK government, because it positions the UK as a bit of a global beacon of stability, making it more attractive for investment. And it already looks like Labour and the new Chancellor, Rachel Reeves, are looking to take advantage of this. One major announcement following the UK election was the news of introducing a National Wealth Fund that will be part government funded and part private investment. The idea of the fund is to create a massive pot of money to invest in decarbonising British industry and moving towards things like green steel, no, not a new nickname for the Incredible Hulk, and also gigafactories, which are the manufacturing facilities that build components and products to help with things like electrification and decarbonisation. The plan is to spend the fund's money over 5 years, distributed by the state-owned UK Infrastructure Bank. Hopes are that this injection of capital will act as a catalyst and lead to increasing growth and investment in the industries of tomorrow. So it could be an excellent sign for UK green stocks and infrastructure investments. However, execution of this won't be without challenges, so it's worth keeping an eye on how it all plays out before going gung-ho with your investments. There's also continuing talk around pension reforms, with the hope of making some long-term changes to the UK system and just finding better ways to unlock some of the potential from the billions that's floating around in thousands of UK pension schemes. Just like a festival might have a surprise set from a popular band, the King's speech contained a slightly less exciting appearance in the form of a new pension schemes bill, which just aims to introduce a bunch of new measures that hopefully will benefit retirement investors and the UK economy as a byproduct. The key measures include making it easier for people to track and consolidate pensions, ensuring that schemes are going to be delivering good value to savers, and just creating better ways for people to access their pots in retirement. Overall, the idea is to streamline the whole UK pension system, making it more similar to the setup that they've got in Canada and Australia. A lot of these changes won't impact you immediately, but the best thing you can do with your pension right now is contribute as much as you can afford to and make sure it's invested appropriately for your age and goals. The other big news is that there's been a shake-up to UK stock market listing rules from the FCA. Essentially, the rule changes will mean that takeovers can happen without a shareholder vote of approval, possibly quickening up sales and just saving money for growing businesses. Now, this may not sound too exciting, but it does make the UK a more attractive place for companies to list shares because it removes just a level of bureaucracy that was there. And this can potentially help boost growth and just modernise the UK market. The downside to this is that it does dilute the power of shareholders, who are going to have less of a say about what happens. As we've just crossed over from the first half of 2024, it's useful to take a quick look over our shoulders and across the pond to make sense of what's happened and what the rest of the year might look like. One battle that does rage on this year and will probably continue into future years is a debate between active and passive investment funds. For a quick refresher, active funds have managers that will buy and sell investments based on their research and their convictions to try and achieve better performance in a particular area of investing. Passive funds, on the other hand, will usually just track some sort of index or industry benchmark and just copy the same investments. Because of this difference, active funds tend to come with higher fees, but you've got the possibility of beating the market, whereas passive funds tend to be cheaper, but they won't beat the market because they basically just keep pace and copy it. What's been particularly interesting so far in 2024 is that the world's most popular stock market index, the S&P 500, which just tracks the performance of 500 of the biggest and the best US stocks, has been performing extremely well and beating most active managers. It's not uncommon for passive funds to beat active funds in terms of performance, but this year is a little unusual. The S&P 500 is market cap weighted, which just means that the biggest stocks receive the biggest percentage of an investment made into a fund that copies the index. Because some of the top S&P 500 stocks like Microsoft, Nvidia and Apple have had a pretty stellar year, they've driven much of the performance of the whole S&P 500. But the size of their market caps also means that about 20% of an investment into an S&P 500 fund is going to those three stocks. And the other 80% of the investment would be split across the remaining 497 stocks. The interesting situation at the moment is that the funds of many active managers are suffering in comparison to the passive options because active funds are not actually allowed to be so heavily concentrated. For most active funds, rules are put in place to make sure that the managers stay diversified, and there are often limits for how much of any stock they can hold as a percentage of the portfolio. There's no telling whether this over-concentration in a few top stocks will allow passive investors to keep reaping the rewards, or if active funds will have the last laugh. Whether you want to go down the active or the passive route, you should still aim to look for funds with low fees and use these investments as part of a wider and diverse portfolio. Thanks for watching. Make sure you tune in next month. And if you want to check out our review of top trading apps like Interactive Investor, click the I over in the right-hand corner or click here for our latest videos.